You there, Thomas?
Yep, absolutely. We'll get started in a second. All right, I think we'll get started. Welcome everybody to another Learn It Live webinar. My name's Thomas Atkinson. I'm joined as always with Tyrone Bella.
Hi, everyone. Yeah, welcome to tonight's webinar.
Yeah, we're really excited to do another one with you guys, of course, this week. A few interesting things have happened in the market, but tonight we're going to be taking a look at the 3 best timeframes for busy Forex traders. So really focusing on kind of some things that you can do if you are working or working part-time or working full-time with your trading that might help you, I guess, get involved in it a little bit more and also not to be a slave to the charts. Because I think a lot of people, when they first start, they might spend 3, 4, 5, even 5 hours a night in front of the charts. And it's very difficult to do that and then work full-time every day as well.
Yeah, a lot of people are actually working while they are learning, especially at the start. So it's really important to not be a slave to it and be able to live your life as normal while you learn. So you basically are fresh every time you're doing it.
Yeah, because actually, you know, there is a thing, and I think most professional athletes will also attest to this, that you don't want to be burnt out, and you also want to be in like peak physical condition as well. Like a lot of people really attest to, if they're going to be professional traders, one thing they like to do, and I think, you know, Tyrone's definitely a big practicer of this, is stay incredibly healthy and eat well. And if you do that, you'll be amazed that it just keeps your mental fortitude really strong. And I think it's something that's probably underutilized by some people out there. So just to get started, we just want to go through the risk warning as usual. The information provided in these videos has been produced by a third party and does not reflect the opinion of Pepperstone, and the information has been provided without any alteration or verification. So if we take a look at what we'll be covering today, one of the first things we're going to be taking a look at is which technical analysis indicators can be used quickly and effectively with some of these timeframes that we're going to be talking about. The other thing that we want to do is we want to look at which timeframes we recommend and use ourselves when trading Forex. So Forex is a pretty fast trade compared to some trades out there. You know, stock market, I guess, is something that a lot of people always look to as well in terms of trading. You generally in the stock market, you won't usually be doing too much 4-hour trading, and some people do, but longer term trading seems to be something that a lot of people do there. So when we're trading in Forex, we do actually speed up a little bit of our trades because we're looking for those sharp entries. So we'll talk about that today. And then we also want to be talking about how to combine our short and long-term timeframes to strengthen your trading convictions, and something that's often underutilized by a lot of beginner traders, isn't it, Tyrone?
Yeah, definitely. It's one of the things that people do miss early on. And we must admit, when we first started, we definitely missed it and went the other way. So it's going to be a valuable lesson for everybody, especially who are starting to learn from people who have made these mistakes many years ago.
Yeah, it's something that you really want to learn from. And then, of course, Q&A. So if you have questions, even if you don't ask them at the end, if you ask them during the webinar, we'll try to get to as many as we can at the end. We usually allow around 10 minutes. And that gives us a good time to interact with everybody here and to answer some stuff that I think a lot of people find very relevant. Because at the end of the day, yes, we're traders, but also your trade is starting out on your journey or potentially well through your journey. So it's great to always answer those questions. So before we start and talk about what swing trading is and everything to do with probably tonight's timeframes, I did want to just quickly jump into the charts and discuss some of the trades we've been talking about since the last Learn It Live webinar. So this is something that we like to do. We like to show you that we are involved in these trades, and we're also involved in live markets. So one of the ones from a couple of weeks ago that we're talking about was the US dollar yen. In particular, we're talking about the kind of bullish movement back up until these 114, potentially even up into the 114.50 kind of highs. And one thing we discussed literally last time was this massive bullish candle that closed above this double bottom here. So this was kind of like a signal that if it did come back and retrace or even pick it up here, we were interested in this trade, weren't we, Tyrone?
Yeah, definitely. And it came back all the way to one of our favorite moving averages, a 20. So anybody who missed the first opportunity certainly would have got in on the second one and would have got a nice move. Yeah, basically, yeah, nearly 130 pips. So,
Yeah, the
and that was
whole
from the
from the
retrace.
bottom.
Yeah.
Yeah, from the retrace actually up to 140 pips there. So that's a nice little kind of daily move and something we were always looking for. And another top tip, I guess we could always say for all traders, is if you are thinking about, let's say, buying at this position off the break when it comes back and retests, one thing we like to do is we like to say only take 80% of what you think might be available. So in this case, we could have thought it might have gone all the way back up to the highs of 114.50. But what would be better and safer to do would be to take around that 80%, which actually works out to be right on these highs here. So just another little top tip when it comes to trading. Another one we were mentioning, and I just want to quickly go over this, was the Euro US dollar. In particular, we were talking about this here, which is this head and shoulders, left shoulder, head and right shoulder. And then we have the break of that neckline here. And then, of course, the retest coming through with this nice rejection candle. So that's really playing out. We're going to come back to the Euro US dollar and US dollar yen because there's even more trades potentially in the direction that we were talking about that might be showing themselves over the next week for us. So that's going to be really exciting as well. All right, let's jump back into the notes. So one thing about swing trading and why I think it's important to tonight's lesson about 3 best timeframes is that swing traders generally hold positions for a couple of days, maybe a little bit less, and never over a few weeks generally. And that's kind of good for us if we live busy lifestyles because we don't want to be doing those sharp scalping moments where we're sitting there on a 5 or 15 minute or half an hour chart where we're getting in and out within 30 minutes to even a couple of hours. But we do want to have positions where we can monitor them maybe once a day or once every 12 hours, etc. It's also, as I said, great for people with busy lives, and we have usually less transactions, but often high quality trades. So what do you think about swing trading, Ty? Would you say this is one, I mean, I personally think it's one of the most important types of trading and one of the best. Would you agree with that?
It is one of the best, especially if you are short on time, because it is, it gives you the ability to basically check the charts maybe once a day or even once every couple of days, depending on what time frame you're looking at. Whereas, the alternative, I mean, long-term trading is obviously different again, but people who decide to scalp, especially when they start early, have to spend an extraordinary amount of time in front of the charts. And that time's not always available, especially if you are working, full-time or part-time when you do start your trading journey. So in regards to actually starting out, swing trading is awesome for time management because it means that we can get a lot of things done. Even we don't trade all day, every day. Even as investment managers, we have to spend a lot of time talking to clients and basically dealing with portfolio issues. So, for us, swing trading is key to be able to actually get our day-to-day work done and still be able to give the charts the respect that it needs.
Yeah, absolutely, yeah, definitely right. And so when we talk about swing trading, we're generally going to want to use these 3 time frames. We're going to want to use daily, 4 hour, and 1 hour. So we use daily usually to define our trend. We use 4 hour to potentially find our patterns, and then or other reasons to be involved in the trade. And then our 1 hour might be more towards actually getting that scalpel-like entry. So when we get our alerts, let's say on our phone or on our email or wherever else we're getting them, we can just jump in. We already have our plan that's defined from the daily 4-hour analysis, which we can do once a day to twice a day. So very, very easy for us to do, and we'll explain that soon. And then the 1 hour, we can get involved in the 1 hour, and we'll actually look at a few recent examples of where the 1 hour would have come in handy to get us an extra entry and get us right in on the action straight away. So one thing we want to do when we're focusing on these 3 time frames is we want to use a top-down approach. And what that means is that we want to start on the highest time frame and then we want to work down. And a lot of people don't do this, do they, Ty? A lot of people never look. In fact, I had a guy this week mention to me, I've never seen that chart before because we were looking at a monthly. And while that may sound crazy, we're at a critical point in the market and he'd never seen the support resistance at that particular monthly chart. So he's like, oh, why would I be buying into this zone? And I was like, exactly. It's why you need to start up there and then work down.
And the monthly charts, as much as you're not going to trade off them, what they do give you, you'll find that the support and the resistance that forms on these monthly and sometimes weekly charts are the key reversal zones that are basically, eye level, round numbers or historical price points that you're not going to see anywhere near closely on a smaller time frame. And you just might think you're trading into a normal area, where you could be trading into a brick wall. And that's the key. You don't have to actually trade off the monthly, but you just have to be aware where the support and the resistance is, because the support and the resistance on those particular charts are the ones that are really going to form a brick wall in front of your trade sometimes.
Yeah, and when you're doing it, remember, it's a monthly chart. You just put it on with a support resistance with a certain color, and that color always means monthly. And guess what? Once you placed it, you really don't have to place it probably for another month or many months away. So
you don't have to
very easy to get my chart.
Yeah,
you just want to know in context where the market's at. So then we want to be able to recognize whether a market is trending or range bound. And that's going to kind of influence the things like the indicators that we're going to use that we might talk about tonight, and also the way that we're going to trade patterns and the way we're going to actually trade the markets and what we're expecting from the markets. Obviously, a trending market's going to potentially give us a higher movement in the market from what we expect, whereas a range-bound market's going to give us a lot more parameters, maybe a tighter stop loss with a tighter take-profit zone. So very, very important we know that.
We probably can't emphasize enough actually how important it is to really understand which market you are actually trading. It is a common flaw in a lot of the students that we actually teach, that they don't actually understand which market they're actually trading. So if they don't know if it's trending or if it's going sideways, it makes it very difficult to make qualified, and quality decisions, when you are going long or short in the particular areas. So it is something, if you're not really sure how, there are many, you just go back through a lot of our webinars, we actually talk about it on how to identify it properly. But it is a real key point that people miss. So make sure you really note that down. The first thing you really should look at is what market you are trading in.
Speaking of other things that everyone seems to fail and not use, is line charts. Line charts are a great way of cutting out a lot of the noise in the market for our support resistance lines. So make sure you start to bring in line charts, bar charts, and of course, what everyone loves, the candle charts into your analysis. Don't fall into the trap of just using one. Something we also fell into the trap with when we first started. It was candles all the way, and line charts, as far as were concerned back then, they weren't very good, but it turns out they were. So, and the last one, of course, picks and pairs. You want to use usually very liquid and big kind of well-known pairs, odd US dollar, euro US dollar, pound US dollar. The reason we want to stick to US dollar pairs or yen pairs or these bigger ones is that they trade very technically. So that's something we want to do. So when we're talking about the daily, 4 hour, even down to 1 hour kind of timeframes, the reason we want to use multiple timeframes for doing our analysis is because each timeframe will tell us a different story. So here we have on the right, we've got this daily candle, and you can see we've got the high, we've got the close, we've got the open, and we've got the low. And this looks like a really nice bullish candle, but then that's going to look very different on the 4 hour side. So Tyron, do you want to break down this 4 hour side for us?
Sure. So the good thing about daily candles, and this is why we give them a lot of attention, is because they're open for basically 3 or 4 major market opens. We're open right through Asia, we're open right through the European and London markets, and of course closing out with the New York markets at the end. Now, in that particular day, everybody's had a crack at defining which way this market is going to go, whether it's going to be a bullish day or whether it's going to be a bearish day. Now, as we can see here, that the first 3 candles, we basically reached half the range of the daily candle, but at the end of the Asian session, you can see that it was actually quite a weak finish. And prior to Europe and London kicking in, this was looking like a fairly ordinary daily candle. And this really highlights why, if you are trading on the daily chart or actually using that as your focus, why you really need to wait for a close confirmation, because this daily candle, as much as it looks bullish now, looks very, very different at the end of the Asian session, I can assure you. It was bordering on looking like not quite a shooting star, but pretty damn close. So, but you can see then once the European markets and London markets kicked in, the trend completely reversed. And if that's the time frame that you are trading, if you are a London trader or trading the London Open and the European Opens, you're going to see some very, very bullish movement in that time. Now, of course, if we break down the 4-hour candles again and take them down to a 1 hour and a 15-minute, we're going to see a series of higher highs and higher lows forming in those smaller time frames over this period. And that's where the clues come in. So we already know from the 4-hour action that, we've got a fairly big bullish candle here. It's completely reversed the actions of that red bearish candle at the end of Asia. So we would be looking to continue that trend. So if we drop down to, say, a 15-minute chart or a 1-hour chart, we would be seeing a series of higher highs and higher lows, which is actually confirming the short-term trend is long for us. So we can see here now when we break it down to a 15-minute chart, obviously we've got a lot more candles in a 4-hour chart versus the 15-minute. And we can see that there's quite a bit more price action to allow us to actually get involved, potentially pick up where a candle might come back and touch a 20 moving average or even a 10 moving average on the smaller time frames. So it gives us the opportunity to get involved in the smaller trend, but having the identification that the daily is starting to move in the right direction for us.
So one thing is with the 4 hours, obviously it gives us a different picture of what's happened during the sessions. But then even when you're looking for candle confirmation or you're looking for confirmation in general, this 4-hour candle, a lot of people are going to know it out there as a shooting star, which is its technical term. And this is a very bearish signal in the market. And especially where it's around a point of resistance, or a point of role reversal, it's going to be quite strong for us to potentially trade off because it's signaling that the buyers have lost control and the sellers have gained control in the market. But it is going to look very different to a 15-minute time frame trader. So the reason this is what it looks like on 15 minutes. So yes, it looks bearish. Yes, it looks down, but this is a way stronger signal for a lot of people. So what you want to do is when you're looking at the market, if we're using a daily, a 4-hour and a 1 hour, we're getting a good cross section of the different things that people are seeing on those time frames. And therefore we get different types of entries and we get different type of signals. And those signals combined together form the case that we want to trade.
And I think that actually, Can I just touch on that candle again?
Yeah,
if we just go back to that candle just quickly, one thing about this candle, and this is why it's important to look at the bigger time frames, even if it is only a 4-hour. If we looked at that second last 15-minute candle, you could be potentially thinking, if you didn't know that the 4-hour was looking awfully like a shooting star, you could be potentially thinking that might be a reversal candle and potentially this short-term trend is going to reverse and go up again. But one look at the 4-hour candle, which is only 15 minutes away from closing, would tell you that this is going to be a very, very solid case for a shooting star if the next candle is bearish, which is exactly what has happened. So, trading without that knowledge of knowing that the 4-hour candle is looking like a very, very bearish candle could get you in trouble very, very quickly on a 15-minute trade, especially when you've almost got an engulfing candle there on that second last 15-minute candle, and you could be tricked into thinking that potentially it could be going along from there, when in fact the 4-hour is signaling a very, very different story.
So why we like trading the 1 hour, 4 hour daily? The main reason is you can come and check the charts literally once a day and you're going to get a good idea of what the trend's doing. The daily candle closes just after the US market close, and then of course it opens for us. If you're an Australian trader, it's pretty good because generally it's somewhere, depending on daylight savings time, between 7 and 9 o'clock generally in our country. So it's really easy for us to be able to jump in there before work, have a look at the daily, see if anything's changed, see if key levels have been broken, and then start to think about, okay, well, now we can break down the 4 hour, 1 hour and start to build our trading plan. It also gives us an opportunity to get a decent amount of trades. So we generally get around 3 to 5 potential opportunities if we have around 10 to 20 trading pairs. And it's pretty easy to open up 10 to 20 trading pairs if you're trading those US dollar crosses, those yen crosses, maybe gold, maybe oil. A lot of people doing that at the moment, of course, and maybe even some indexes through the Pepperstone platform. So that can always be quite good. And of course, you can always consider back testing your strategy using MetaTrader 4 or CTrader on these timeframes and checking out each one as you go back. So before we get into moving averages, I want to jump into the charts and I want to talk about the odd US dollar just quickly here. The reason I want to talk about that is because it tells a story on different time frames. So I think a lot of people would agree if you come and have a look at the general overall consensus of what's been happening with the Australian dollar recently, it's been kind of short or bearish. I mean, consistently, there was pretty much a massive kind of trend line here where it got broken recently, but every single time it's been selling off this kind of zone. And the reason why that's important is because it is bearish, and therefore we can start to go with, or maybe we'll look for bearish signals. So recently came up to these kind of highs here. We saw it around this 73 level. That's a nice psychological level. If we were looking at potentially shorting this market, either back down into this kind of zone here or back down to the lows, and we were interested in getting involved in this, on the daily, okay, it's back up at this 73 level, but that's not going to be enough reasons for us to potentially be in a trade like this. So then what we can do is we can break it down to a smaller time frame. And one thing that Tyron and I were just discussing, and we saw before, one of the students saw this week, was they were looking at this 73 level, and then they saw this on the 4 hour, and they went, oh, wait a second, I see this. Let's break it down to that 1 hour. And a few people may recognize what type of pattern this is, but this is actually a double top. So we've got our high here, followed by our equal high and our intervening trough, and that was broken by this nice big bearish candle. So what that is telling us is this is a signal around this 73 level where we could be looking at getting into a short. And it's even more, well, it's even better, because after breaking through and confirmed closing, it's come back and it's retested that intervening trough level. And that's exactly what we want to see, isn't it, Ty?
Oh, definitely. And when that happens, I mean, that's just trading perfection on the 1 hour chart. Like if you did miss the initial break, and in fairness, when that did break, we would never trade that, because that a confirmation close would be required for that to be a valid trade anyway. So we would have to wait for this retest of the neckline from below it to actually enter this trade. But when that did happen, we've basically got the short that we've needed from the break of the neckline. But also, as you can see, nearly all the way down, the 20 has provided the resistance that we've needed. So even if we've missed that initial short, if we weren't there at that time, which is quite possible because it is an hour chart, it's given us multiple opportunities. There's been 3 opportunities there where it's come back and retested and touched the 20 moving average and sold off at every single time. So hopefully everybody can see how clear that is. And this is why the 20 and the 50 moving averages for us are key moving averages, because they're the ones that price reacts the most heavily with. If the 20 can't hold the price action in, the 50 generally does. So, but on an aggressive short, it very rarely gets through the 20 without some sustainable move down. So that's a really, really good example of why we look at that 4 hour or daily time frame and then break it down to the smaller ones. And technically, are we scalping there or are we swing trading? Well, look, the line gets a little bit grey depending on how long you're going to be in the trade for. But for swing traders there, you've had at least 4 opportunities to actually short, where you really didn't need much action to didn't need to sit in front of the charts all day. These are 1 hour candles, remember. So nearly a day is passing every time there's a cycle there.
But more importantly, we were able to analyze this support resistance level off the daily. So what that meant was that when we came and we saw the Australian dollar had made it up to our zone, so maybe it hadn't made it here, but it did make it up here. It found our zone, and then we can start to break down the smaller time frames. So we only need to do that once our daily is hit. And that's why daily is a great place to start, because that gives you that idea of, okay, this is now the market I'm looking at. You've now got some specific trades or trading styles that you can be looking at, and you don't need to spend all the time on another pair, because that pair hasn't currently given you the daily signals. When the daily signals are there, then we start looking for the scalps and the smaller time frames on the 4 and the 1 hour. So a little bit easier when we have that busy lifestyle.
And I think the thing is too, with this daily, a lot of people look at that and they say, well, technical analysis is easy after the fact. And look, in fairness, if you looked at that daily chart there and you looked at the last 5 candles, you'd say, okay, we had 3 very bearish candles, and you wonder, how do we actually get into that? Where do we actually trade that? But the example we saw on the 1 hour, we saw 5 very, very good opportunities to enter every single time on a pullback. So when you do break it down to the smaller time frames, particularly the 1 hour on a daily setup, you are going to get those entry points, and they're very, very clear. So it's really, really good to drop back and take that analysis to the next level, where you can enter it at the pullback. So you're not really just buying, at the exhaustion point of a trend.
Another one I want to bring up, just because this is what we always do as technical analysts. It may not look that good right now, and maybe it was completely break tonight, but we always want to be thinking about, is there a pattern forming on our daily as well? So here's the S&P 500 daily, and what we'll notice is that we have a potential inverse head and shoulders here if it was not to break this right shoulder tonight. So you can see this is the kind of pattern you see forming. Ideally, what we would see is that price actually wouldn't even be here right now. It'd just be a little bit higher around this point. And then if it did consolidate and come back up and then broke past this neckline here, then we could be looking for long positions on the S&P 500. So it's just something where we're being patient. We're using, again, the daily as our indicator. And then once we've got that daily, if the neckline had broken up here, then we can start to look at the 4-hour, 1 hour. And because we live those busy lifestyles, we don't have that much time. Unless we're getting the signal that it's up at this point, we don't necessarily need to be looking at this pair if that's our trading plan. So it's just another way of saying, okay, that's our trading plan. We're waiting for that point. If it doesn't happen, that's fine. We move on to the next one. Just being patient.
It's patience is key. And look, the thing is, we could be expecting this inverse head and shoulders to play out. Do we know at this point? Well, of course not. But if it does, it gives us a very, very clear signal, and it also gives us a very clear potential target for it as well. So patterns are really, really important on the bigger time frames, especially when you drop them down, going in the direction of where you think it might be going.
Of course, yes. So another one that we wanted to bring up, and Tyrone alluded to the 20 or the 21 moving average. Moving averages are something that we use a lot, especially if we want to quickly analyze charts for either the way they're going in trend, or we use them for dynamic support resistance. So as Tyrone said, on that 1 hour chart, we had every time the Australian dollar was coming back up, it was touching that 21 or 20 SMA or EMA. It'd be very similar in this case. And it was literally finding resistance at that point and then selling back off. So we love using them for dynamic support resistance. And I think a lot of traders only use them more for finding trend, as in when they cross each other, but it can be used also as dynamic support resistance with other zones. I think that's heavily underutilized. Here we've got the example of the 50, and you can see, and even the 200, and you can see that when the market comes up and it hits this 50 or 55 EMA, it finds that resistance, and then sells off. And you can also see when it hits this 200 for the first time, very significant EMA, it finds resistance and it sells off. So when that's in key zones with support resistance or role reversal or some of the other things we've covered over the last couple of weeks, you can be using that as a tool. And it's very simple. It's very visual, very easy to use.
When you are analyzing a lot of charts and trying to analyze them quickly, it is a very, very easy way to identify where the trend is going, without doing a hell of a lot of research. And then you can delve deep into the ones that are actually looking, like they're doing what you want them to do without having to go, too far into price action. So as a starting point, it's a very, very quick and easy way to identify, where a trend is on a lot of charts very quickly. And that's what we like about them. And it's really good to make sure that you understand which moving averages you're looking at and make sure you got the colors right, so you don't have to sit there and hover over the mouse every single time you want to know which one's which. You should be able to know instantly.
So one thing we like to do, as we said, on the daily, we have the 200 moving averages, the 55 and the 21, and you'll see how price has interacted with this 55 on the way down at the key levels. We especially love these kind of points where it's come off kind of like the high up here where there's role reversal exists, and role reversal is where support becomes resistance, and then you've got this beautiful rejection shooting star candle coming off the 55. That's the kind of stuff we want to see. And the great thing is, if you're a day trader and again you're working, you check it once a day, you see this kind of candle, you can put your sell limit just below this candle here, put your stop loss above, and of course take it all the way at least into potentially the lows down here, or 80% of what you expect. And that happened pretty damn quickly. So that's the kind of thing, when you're building that story, excellent stuff. All right, we'll jump back into the charts because we have a little bit extra to cover here. Another one we love to use, Fibonacci retracements. We've discussed this quite a few times. We're really big fans of the 38.2 and 50 fib. The reason why is because we really don't want the market pulling too far back when it's in a trend. So 38.2 and 50 fibs, very, very good, easily applied to your charts, incredibly fast to do. And that's why, again, it's good if you're living a busy lifestyle, because just super simple for us to place on. The way you want to place them is you want to click from the low in an uptrend, click from the low or the last swing all the way up and release it at the high, and you'll see that it automatically applies no matter what of the trading software you're using, CTrader or MetaTrader 4 or 5, and the opposite for the sell side. One last one we don't have in the slides that I'd like to attach is just going to be the MACD. The MACD we will cover actually in probably a masterclass over the next coming months. We'll actually go and really delve deep into the MACD because it's such a popular indicator that literally all the big guys use, don't they, Ty? I mean, you did so much work on the MACD.
They did. I actually did a master's on the MACD. But if anybody's actually really interested in MACD trading, we are going to be talking extensively about it in tomorrow night's webinar as well. So yeah, feel free to join us in tomorrow night because we are looking at MACD and how it's actually interacting with the current price markets at the moment. But we will do a masterclass on it for a Pepperstone webinar in the coming weeks as well, because I know a lot of people are interested in it, and it is a very powerful indicator.
A lot of people literally just add MACD to their charts. They put it on their daily. You'll see in things like the UBS reports or the Goldman Sachs or JP Morgan, a lot of reports you probably won't have access to, but we've seen them plenty of times. They will talk about the MACD on the daily, switching from the positive to the negative, or the negative to the positive. And what that means is basically when this kind of happens. So you've got here, it was positive, the histogram was above, and then it switched to below. And at that point there, what that signal is telling us is that the market is probably bearish in terms of the MACD, and we're looking for the sell side. So if you can have a selling off MACD and you have other reasons to get into the short, again, extra strength to our trade. So something we really want to do there. Okay, one other thing we want to do when we're living or kind of working a lot is we want to be able to optimize our entries and of course our stop losses as well. So we want to enter based on confirmation, not on gut feeling. Easiest way to do that, wait for those daily closes, wait for those 4-hour closes or 1-hour closes for confirmation, and then we can get involved in the trade. We also don't want to break even our trades with fixed pip amounts. Use percentages. Now what this means is if we had, a lot of traders usually say, oh, I've got a 50 pip stop loss for every trade. Now, if we're trading multiple time frames, we're trading the daily, 4-hour, and 1-hour. If we're taking a trade like we had on the Australian dollar, where it was a double top on the 1 hour, a stop would have to be behind the highs. But it wouldn't be a very big stop. It just needs to be behind the highs. Now, if that was on a 1 hour, it may only be a 30, 35 pip stop. But if it was on a daily, that particular pattern, it may be a 100 pip stop. So we want to always use market adaptive stops, that we're looking at the actual charts and saying, okay, where was the highs, where was the pattern highs, that kind of thing.
I can comfortably say that it would be almost impossible to trade successfully with a fixed amount that you were going to only do the, say if you decided 50 pips was going to be your stop, that would only work for one particular strategy on 1 or 2 particular time frames. It would not give you any adaptive ability whatsoever to maneuver around the market. So if you're looking at, and not only that, it's not even about the time frame sometimes, it's actually about the pair. Like sometimes, a 50 pip stop loss might be ideal for a Euro USD or a Pound USD that behaves itself. But then you might go out to an exotic pair like the Pound Yen, where a 50 pip stop, that they eat that for breakfast. So it really depends on some of the currency pairs that you're actually looking at as to whether or not the stop loss is going to be okay. But adaptive stop losses are key to being successful at trading because it gives you the maneuverability and also the trading ability to be able to stay within what the chart is telling you. That the chart and the movements dictate where your stop loss needs to be, not a fixed amount in your head.
Yeah, definitely. It's just the only way you have to do it, basically. We didn't start doing that, but then again, when we started, maybe we weren't as successful as we are now, of course. So the thing is, you have to be able to be adaptive, and that's the way that you're going to have more success in the markets. So I wanted to show everybody this US dollar yen. Sorry, I'm just losing my voice. And I wanted to show, of course, we're looking at more the bullish side right now on this US dollar yen. But if we see this on the daily, and we see this kind of consolidation of candles, but the candles kind of have no idea what's going on, we can jump straight into our 4-hour, and then that might present us with a different kind of scenario. And then, of course, we also can potentially open up the 1 hour and start looking at that as well. And the reason we do this is because then what we can do is we can draw up our support resistance lines. And what a few of you will see here is that we're kind of trapping price. I mean, price has had a really hard time closing above this 114 kind of 2015 area, and it's had a really hard time closing below this 113.70 area. So what that's going to allow us to do is potentially place trades within this zone if we get strong other reasons to do it, or if it breaks out above this 114.20, that's going to be a fairly significant break, because that's going to say, well, the market was finding a range within this zone, and when it does break out, we know the trend's up currently on the daily, the trend is up. So therefore, what do we think is going to happen? It's most likely going to shoot out and potentially even take out these highs. So that's the kind of thing that we want to be doing. We want to see this consolidation here. We want to look for patterns on the smaller time frames and then potentially trade those breaks on the 4 hour, 1 hour. And that's why, again, we love these 3 time frames.
If this happens to make a new high here and consolidates and breaks above it, going long on the USD yen is going to be like swimming in the direction of a waterfall, because there's just nothing in front of it all the way to about 118. So
I don't know if I want to fall off the waterfall though.
Well, that's where you're going to have to actually read the market a little bit. But the good thing is, and we advocate a lot of this, is that when you are trading in a particular direction, identifying where any potential obstacles are going to be in your way is key to making sure that your take profit is achievable. But as you can see here, even if we take this out to a daily chart, I'm not even sure a daily will actually expose it, but we'll just bring this down, magnify it down just a little bit, just to give us a bit of an idea as to how little traffic there is in front of us above that 114.30 area. So as you can see here, the previous highs, where are we still on the daily? Can we take this out to a weekly? Actually, let's take it out to a weekly to really show. And we'll just magnify it down a little bit. There we go. So as you can see, the next point of call for this particular trade is, around the 118, 119 area without a lot of trouble in front of it. So that's, as traders, that's what we're looking for. Now, this is not exactly a swing trade. Of course, this is more of a longer term trade, but the yen, when the yen does actually move, it can move very, very quickly. As you can see, what happened in August of 16, it moved from 101 to 118 in the space of not very long, about 7 or 8 candles on the weekly chart. So in the space of 7 or 8 weeks, it moved 8 cents.
That was Trump.
18 cents, sorry. So that's what we're looking for. So ideally, we're keeping a very close eye on this particular position, because if we do get a solid break up the top and get confirmation of it, we're looking at rosy fields in front of us. And if it does happen to pull back and give us that role reversal that technically is even better than the initial break, then we've got some very, very clear signals. We take it down to a smaller time frame, start picking up the new higher highs and higher lows, and off to the races we go.
Yeah, it's just, this is a very key level. I mean, if you see especially this 114 kind of level break and it closes above, I mean, the last time it closed above this on a weekly was all the way over here at the 2017. It's quite a long time ago. So when we're looking, and that's why we always advocate, still have your weekly, monthly ideas, because if you were just trading the daily 4 hour, 1 hour, if you were just doing that, you may not see these critical levels. This is such a critical level. The space between here and here is 400 pips. And when it does break this level, statistically, it's more likely that it does gravitate back up to these highs, because it's probably done so for a reason.
I would argue that this level, the 114 to 114.50 level, is just as crucial for the USD yen as the parity. That's how strong this resistance is at the moment. So, if the parity was strong, which it was, this is going to be, on equal par with it in recent times.
All right, just to rush through a few other concepts. Role reversal, we've covered this many times. Please go watch some of our other webinars if you're interested in it, where resistance becomes support or support becomes resistance. Incredibly good for when we're trading in the trends. This is kind of like what it looks like in the market. So you've got that resistance becoming support, and then it continues on in the direction. And then, of course, we want to target, in terms of step 4 of our 3 kind of time frame trend stuff, we want to target higher R multiples. And what this means is that when we're taking trades similar to that Australian dollar short based on the daily and then into the 1 hour double top, is we want to aim for over 1-to-1 trades. So if we're looking at a daily, we're seeing resistance, we're getting into a 1 hour, seeing a double top, it's probably going to go further than just the double tops distance. And therefore, we are going to be able to aim for more than 1-to-1, where we risk maybe $100. We want to be at least rewarding ourselves with over $100. If you're not doing that, generally long term, you're not going to have much success.
I think it is key with swing trading in particular that you're aiming for the 1-to-2, 1-to-3 type returns, because 1-to-1 is really a scalping type of strategy. And look, it certainly works if you've got the time to look at it. But as a swing trader, generally the stop losses and the take profit levels that you'll be aiming for will generally net you that 1-to-2 or 1-to-3 return, which is really the ideal sweet spot for swing traders.
Okay. And then, of course, we want to look for trades that are good looking and meet our criteria, whatever our trading system may be, and then practice, of course, discipline as much as possible. Another thing that we want to do is we want to create things like our trading systems. So as we mentioned before, these are some of the things that we'll use. We didn't add Bollinger's Stochastic, but I encourage everyone to look up Stochastic. If you're in a range-bound market, Stochastic indicator, very, very good to add onto your chart very quickly. Bollinger's are really good as well. I think we're going to cover that a little bit more in the coming webinars. We'd love to go deep diving into Bollinger, often underutilized indicator. So if we had, let's say, simple moving average cross acting as dynamic support or resistance, we had things like support resistance actually in the market, candle confirmation like a shooting star or a hammer, those kind of reasons to be in a trade. If we at least had 3 or 4 of these, or 75 points as we've placed below, then we could potentially be looking at placing that trade. And that will give us higher statistics because we're finding more reasons to be involved. Tyrone, you want to run through this really quickly? Just something we do?
Sure. We always operate every trade that we place through our Pressix system that we design. So basically, we take elements of all of the things that we've discussed tonight and a little bit more to give us proof of any of the ideas that we're looking at. So if we're going to go long on a particular trade, we would be looking for price action first and foremost. Then we would be making sure that our risk management is correct, which is just an absolute must. The ELD 363 system is our proprietary multi-time frame system. We will talk about that on another webinar. Chart patterns, of course, that's referring to the double tops and double bottoms we were talking about tonight, and the head and shoulders and potential inverse head and shoulders. The indicators that we were talking about are the MACD, stochastics, moving averages, and the like. And the charting techniques we refer to as things like trend lines, role reversal. We've got Fibonacci retracements, all the techniques that we can apply to the charts to give us that bit more information to make sure that we're not missing anything on our potential long trade. So it's really bringing all of these elements together, which makes every trade not so much impossible to break down, but it's forcing you to actually explore every avenue of what could happen to that trade. So that's why it's important to have that plan.
Just before we go into Q&A time, I just wanted to come down here on the euro. One thing that we did not just quite get to, you'll see the euro is broken past a key support level. And again, we had thought about this head and shoulders, and that's got a little bit more room to go. So this is going to be a key level where you do want to break down things like the daily into the 4 hour, into the 1 hour, and you want to start looking for reasons potentially to be in this trade. So let's say we saw the market come back up and test this zone again, and then come back down like that. That would be forming a double top on the 1 hour. That's the kind of thing where you're getting that extra confirmation the market's pretty sure it wants to go to the next level. So just think about those kind of things, start applying those into your trading systems, and it should help you quite a lot. Now I'll hand it over. Do we have any questions in the room tonight? I think we've got 1 or 2.
Okay. Yeah, I do. Okay, so I've got a question from earlier that I promised I was going to answer. It was one in regards to how do we identify a moving market, a sideways moving market or a trending market. Okay, so we did touch on it a little bit tonight, and the best way and probably one of the easiest ways to identify a trending market is by firstly looking at the moving averages. The simple way to identify a trend that's moving in a decent direction and a decent speed, is making sure that the price action in a downtrend is below the 20 and the 50, as we can see here on the chart. And as you can see, it's accelerating away from those moving averages. So the further away price gets from the moving averages in a downward direction, the stronger the trend is. Okay, and the same goes for an uptrend. To identify an uptrend, we want price action to be above the moving averages, in particular the 20 and the 50. And what we also want to see is acceleration from the candles away from the moving averages. A series of higher highs and higher lows is always very important. So we're always looking for that series of higher highs and higher lows to confirm the trend is up or down. Now, in a sideways market, the best way to identify a sideways market is to actually draw support and resistance lines that we also touched on. Now, support and resistance lines basically form what we call a channel. Now, when the market is channeling or moving sideways, if you like, we know that the movements aren't going to be as predominant, especially, or as explosive until that channel breaks. So we trade that sideways moving market in the confines of what we're sort of seeing. So if we can see one here that Thomas is drawing up now, where we've got a sideways moving channel on the Euro USD weekly. So in that time, we know that the confines of the resistance line at about the 114 and the support line at around the 105 has maintained the majority of that price action since 2014 all the way to basically the middle of 2017. Now, I know this is on a weekly, but you can apply the exact same method to any time frame, really, even as low as a 1 hour or 4 hour channel. You just trade within the confines of that support and resistance until the market tells you otherwise.
Okay, I think we ran a little bit over time today, so we'll go with time for one more.
Okay, I've got a question here on how we use the dollar index to help confirm trades, how we look at the majors in relative terms to the dollar index. So you want to take that one, Thomas?
Okay. Yeah, of course, I'll take this one. So one thing with the dollar index is we need to be aware that the closest correlation to the dollar index is going to be the euro US dollar. And that's because it's the second most traded currency next to the US dollar itself. So one thing we like to do is we don't necessarily trade the US dollar index itself, but what we do is we break it down and we start looking for potential patterns on this. And if we see patterns or breakouts like we're kind of seeing here at the moment, then we can use those against maybe correlating with the euro US dollar. So funnily enough, what we noticed a few weeks ago was we noticed this inverse head and shoulders on the US dollar index. You can see here the left shoulder, the head, and then we have the right shoulder over here. And we saw that break and we saw it retesting this neckline. And that was the exact same time as we saw the euro testing its neckline as well. And that gives us extra confirmation that what's happening on the US dollar index is also probably happening on the euro. So therefore, not only do we know they're correlated, but we know that there's patterns playing out on both. So we're going to have a lot more force in that direction. And consequently, it's been quite a successful trade. So it's just about putting those, stacking as many reasons again in your favor as possible. And another great thing about this is we can see that the US dollar index has broken out of that key resistance zone. And may even, now it's probably going to travel up to these kind of areas up here, could be potentially its next stop.
Definitely. So we need to wind it up tonight, guys. So we've gone a little bit over time. We need to give a little bit more time for question times next time because we've got quite a few questions coming through. But look, don't be afraid to email some of these questions if you like. If you need some clarity to them, you can. I'll pop an email address here that you can actually send them to. And feel free to click on the link and join our webinar tomorrow night if you want to look at the live markets. Thomas will give you a bit of an explanation as to what's happening tomorrow night.
Yeah, so tomorrow night, we also do webinars once a week at FX Evolution, so you can always come across and have a look at some of the ones we do there. We like to really go into the live charts, a little bit less theory, but I think theory is obviously incredibly important, but we like to jump into the charts, have a look at some of the potential patterns and things that are setting up, and then discuss them with some of the community members. So if you want to, come along. Otherwise, we'll see you in the next Pepperstone webinar, and we look forward to it very much.
Thanks a lot for your time, guys, tonight, and you have a great night. We'll talk to you soon.
Thanks, everyone. See you next time.